Does it feel like every time you enter the market, you keep getting hit with losses after losses and after more and more losses? It seems as if every single time you enter a position, somebody on the other side is saying, all right, he's in, let's reverse the markets. See, one of the biggest issues that most traders are facing is not knowing where to find the order blocks or anything like that, but it's all about finding the high quality ones. Now think about it. If your point of interest is always incorrect, no matter how great your trade management is, no matter how great your risk management is, there's no way you'll become profitable. But here's the thing. The reason that you keep entering incorrectly is not because you don't know how to find the order blocks. It's all about selecting the high quality ones. And that's exactly what we're going to go through today. The do's and don'ts on how to find them. Now, by the end of this video, we're going to go through the 4 main rules of high quality order block selection. And then finally get into the 3 main types of entry models that I personally use as well, especially the ones that get higher risk to reward as well. By the way, if you don't know me, my name's Diamant. I've been trading full-time for around 4 years now, mentored close to 3,000 students, helped hundreds of traders get funded, and some of them who are even making 4 to 5 figure payouts as well. So let's get straight into this. Now, looking at the 4 main rules of order block selection, we're going to go through this quite quickly and look at a few examples as well. Rule number 1, the order block caused a break of structure. Now, what does that mean? If we are looking at price action over here, we can clearly see we are in a downtrend. Now, this over here pretty much wicked the low. So we're not completely sure that price is broken down. However, until we saw this order block and then the follow through, that's when we finally saw the major break of structure. Price then pulled back to it. And then finally, we got that high quality order block. It wasn't this area. It wasn't the breaker block. It wasn't an order block up top either. It was this major one over here. Rule number 2. The imbalance formed after the order block. So what does that mean? Whenever you have a high quality order block formed, essentially what you want to look for is an imbalance or a fair value gap formed straight after. Essentially what that means is price has pushed it so aggressively that there's only sell price action. When there's only sell price action, that causes inefficiencies in the markets, also known as imbalances, also known as fair value gaps. So that's rule number 2. Rule number 3. The order block has to be above the 61.8% fib retracement. Now, this is also better known as the OTE, the optimum trade entry in ICT terms. Really and truly what it is you've got your most recent range. We've got the high, we've got the low. Price eventually pulls back into greater than 61.8% fib retracement. And that's all you need to know. So let's say, for example, you have multiple points of interest on your way down and multiple order blocks. You're going to choose the one that's in the most premium zone. In this occasion, we've had this one right at the top. Rule number 4 is going to be the order block hit. The order block is hit during London and New York kill zone. So what I've gone ahead and done over here is just highlighted when price has actually formed during the session. So you can see here, for example, this order block down here was formed during London session. This order block over here was formed during New York session. Eventually, price pulled back and encountered this area right at the order block, which was formed during New York session, and then continued downwards. Again, I don't know what the explanation for this is, but I've just found this to be true over and over and over again. The highest quality order blocks are always going to be formed during either London or New York session. And we're going to get into a few examples of how to actually look for that as well. So just to save this short 4-step checklist and take a note of this. Rule number 1, order block caused a break of structure. Rule number 2, an imbalance formed after the order block. Rule number 3, order block is formed above 61.8% fib retracement. And then finally, number 4, order block is hit or even created during London and New York's kill zone as well. Now, knowing this is all well and good, but how do you actually execute on the trades? Because many of you have that great higher time frame analysis, but when it comes to the lower time frame, that's where you're struggling. So here are going to be 3 main entry models that you can actually go ahead and implement today. Method number 1 is a higher time frame entry limit. So let's say, for example, we were working on the 1 hour time frame. It's going to be as simple as setting your entry at the bottom of the order block, your stop loss just above, and your take profit right at a relevant zone. For me personally, what would I see as a relevant zone? It will be that external liquidity resting over there. Again, if you want to take that a level further down, what you could do is aim for internal liquidity. So for example, it could be this low over here, could even be this fair value gap formed over here. There's many areas that you can aim for. But for me personally, external liquidity is always the nicest to aim for. Method number 2, you want to go for that higher time frame engulfing entry. So have a little look at the previous one. What this was we had an entry limit on the actual order block. This one over here gives you that extra bit of confirmation. Why? Because as soon as the order block is actually hit, what we expect is for price to continue downwards, right? But how many times have we seen where price literally hits it, comes down a little bit, and then reverses upwards and breaks past your stop loss? This will actually avoid that from happening. So what you can go ahead and do is set your entry execution as soon as we get an engulfing candle away from the zone that we've had over here. In this occasion, this was the candle that broke these past few candles over here. Stop loss just above, and then price again, take profit at the low. Method number 3, so this one's going to be a bit more complicated and we're going to get onto the charts for it, is a lower time frame London and New York entry. This is as simple as waiting for strictly just London and New York. So in this occasion, what we can actually see is price hit during New York session. However, it didn't really give us any sort of entry, but we saw the entry in the next day. So let's get onto the charts and have a look at this little example here. So getting into this little example that we've seen, as you know, this was the structure that was actually forming. We got our major breaker structure or our change of character around this zone. Price eventually broke it, pulled back and gave us this order block. We had a further breaker structure even further down over here, and then price eventually pulled back. Now, on this particular day over here, London session was still making its advancement towards the upside. New York session continued on with that rally, but it was only until the end of the day where we really started to see any sort of change of character to the downside. Remember, whenever we're looking at lower time frame entries, we always want to look for a minor change of character, and then we look for that pullback and entry. Unfortunately, that didn't happen within this day. So yes, we know, for example, that this order block was formed during the previous New York session, but within this particular New York session, we actually were not able to get into our entry. Now, moving on to the next day, what did we actually see? We've clearly got over here the New York and London kill zones. By the way, if you're wondering, ICT actually refers to them as over here from 7 o'clock up until 11 o'clock GMT. If you're actually looking in New York time, let me just quickly bring that up. New York time, that will be around 2 a.m. to around 6 a.m. Some people take it up to 5 a.m. Again, I've got my particular timings with this, but generally speaking, you can really stick to these timings. Now, as we saw, Asia session actually formed. And the good thing is Asia actually gave us that nice consolidation. London session then went to sweep this particular area over here. So as soon as you would have seen that price is now moving upwards, you could have actually set your entry limit at this particular point where price has hit this lower time frame order block above resting liquidity, above Asia session. So that's exactly what you want to look for. You want to combine the higher time frame narrative with your order blocks. You want to combine time and price, so looking at Asia consolidation, looking at that London sweep, also known as the Judas swing, and then eventually you want to look for that particular entry on the lower time frames. This particular order block looked quite great, so you're just going to set your stop loss just above, and then your take profit as well. Again, it is going to depend. If you are on the lower time frame and you don't want to risk getting stopped out, what you could aim for is literally just lows like these over here, and potentially even areas further down. So let's say, for example, this gave us a nice fair value gap where you could have aimed for. Even with something like that, you're going to be aiming for a nice 1 to 3. Now, when it comes to my personal strategy, I actually go for consistent mechanical 1 to 3s, and it works quite well. Again, if your higher time frame narrative is actually showing you that, yes, we are going to continue downwards, you could take some profit. I would generally say around 75% of the profit at the major low, and then wait for price to continue onwards. This is the exact idea of how we link the higher time frame all the way down to the lower time frame entry models, and it's as simple as that. Okay, so now that we've actually looked at that lower time frame entry model, let's look at some key takeaways from today's video. Number 1, you only want to enter high quality points of interest using 4 main rules. And here we've actually got them as well. It's the same as before. Number 2, engulfing candles around points of interest always will give that extra level of confirmation. Whether you want to do it on the higher time frame, as we've seen in this particular example over here, or whether you want to even do it on the lower time frame as well, it's always going to give you that extra bit of confirmation. Number 3, the lower time frame can massively increase your risk to reward without changing much analysis. As we've seen from this particular example, we actually went from maybe a 1 to 3 to something like a 1 to 5 just by looking at the lower time frames. And it's as simple as that. Now, by the way, if you're actually wondering how I enter my 1 to 3 risk to reward mechanical trades that I've just mentioned, just like some of these over here, based around the Asia range model and everything like that, I've basically taught it for completely free. If you download my free 7 module advanced liquidity course down below, it's completely free, quick and concise, and very, very easy to understand. I've literally broken down every single part of the strategy in very bite-sized videos, so you can actually understand that there. And by the way, remember to like, comment, and subscribe because I really do appreciate some of the growth that's been happening recently. And if you want to look at that 1 to 3 strategy that I use more and more, click on one of these links on the video right now. And yeah, guys, thank you for tuning in. I'll see you all in the next video. Take care.